Hello and welcome back to the Geordie Pig Investor channel, where we delve into the world of dividend investing to help you build a portfolio that pays you. Whether you're just starting out or looking to maximize your passive income, this channel is your go-to resource for strategies, insights, and the tools you need to grow your wealth steadily over time. Hit that subscribe button and join me as we explore how to make your money work for you, one dividend at a time. In today's video, I will be going through how to identify a value trap stock and talk about the common cause of it, how to avoid one, and different examples of value traps over the last few years. What is a value trap? A value trap is a stock that appears to be undervalued based on traditional metrics like the price to earnings ratio, price to book ratio, or dividend yield, but continues to underperform because of underlying fundamental issues. Investors might buy these stocks thinking they're getting a bargain, only to watch the price stagnate or decline further. Common causes of a value trap. I am going to go over some of the main causes of a value trap and talk through some examples of different well-known companies that became a value trap. One of the main common causes of a value trap is declining business fundamentals, such as revenue and earnings starting to fall due to weak demand, poor management, or a failing business model. A good example of one is Blockbuster, who were valued at over $5 billion in 2004, but by 2010 they had to file for bankruptcy. This was due to them having declining business fundamentals and failing to adapt to digital streaming and online rentals. They continued to rely heavily on in-store DVD rentals, and in the year 2000 turned down the chance to buy Netflix for $50 million as they doubled down on physical stores. Ultimately, this led to their bankruptcy. I'm sure they'll be kicking themselves even more so now, knowing that Netflix is worth over a staggering £400 billion right now, compared to that $50 million that they could have bought for back in the year 2000. You can identify such difficulties within a company from their earnings calls, which is why it's so important to only have an amount of stocks within your portfolio that you can personally keep up with and track whenever the new earnings calls are released, so you don't miss out on any new information about the company and can recognize if issues are creeping up and sell out of a stock if the red flags are showing on a consistent basis after multiple earnings calls. Another common cause of a value trap is industry disruption. Industry disruption can be bad for a stock because it threatens a company's market share, profitability, and long-term survival. When a new technology, business model, or competitor fundamentally changes how an industry operates, companies that fail to adapt often see declining revenue, shrinking margins, and falling stock price. Industry disruptors can introduce cheaper, more convenient, or superior alternatives, causing traditional companies to lose customers. An example of this is like taxi companies against Uber when it came onto the market. Traditional taxi businesses suffered as ride-sharing apps offered easier app-based bookings, and a company like Many Taxi Medallions, which was once worth millions, became worthless. If a company fails to adapt, it may become obsolete, get acquired at a discount, or file for bankruptcy. A different example for this would also be Kodak versus digital cameras and smartphones. Kodak actually invented digital photography but didn't embrace it, and their own stubbornness led to them filing for bankruptcy in 2012. Meanwhile, the companies that embraced it, like Apple and Canon, thrived and increased their market share significantly. So it's important to note that industry disruption isn't always bad. If a company does adapt, like Microsoft successfully pivot in the cloud computing, which led to them adding a lot of additional value to the company, then it's a positive for the business. But if a company resists change, it often turns into a value trap rather than an opportunity, and that's what you need to be looking out for. Another common cause of a value trap is high debt levels. A company with high debt can struggle to grow, reinvest, and even survive because debt comes with fixed obligations. When debt levels are high, it means that they can have limited cash flow for growth and reinvestment, and this is going to make it very hard for the business to continue growing. If revenue declines or margins shrink, debt payments become a burden, making reinvestment nearly impossible. Not only this, but if a company has high debt levels, then it's going to find it very hard to raise more capital. A company with excessive debt may struggle to secure new loans because lenders view it as too risky. Issuing new shares could be an option, but that dilutes existing shareholders' shares that they own and can be very negative over the longer term. Vulnerability during economic downturns and recessions or industry slowdowns, revenue often will decline. Companies with high debts and fixed interest payments have less flexibility to cut costs. If a company has mounting debt, declining revenue, and shrinking cash reserves, then it will ultimately lead to bankruptcy. However, on the flip side, some companies can handle debt if it has a strong, consistent cash flow, such as Apple or Microsoft. The final common cause we're going to have a look at for value traps is management issues. Management issues can significantly affect a company's performance, valuation, and long-term success. Poor leadership can lead to declining revenue, strategic missteps, low employee morale, and loss of investor confidence. If a company has poor strategic decisions and bad management, then it may lead to misallocated capital, investing in unprofitable ventures, or failing to adapt to market changes. Again, such as Kodak that we mentioned earlier, who failed to embrace digital photography despite inventing it, allowed competitors to dominate the market and led to their bankruptcy. Not only this, but insufficient operations such as weak leadership can result in high costs, operational bottlenecks, and declining productivity. So a company that overhires without efficient processes may struggle with profitability. If investors lose trust in management's ability to execute, the stock price can suffer. An example of this was WeWork lost billions in valuation due to reckless expansion and leadership issues under Adam Neumann. Bottom line is that even a fundamentally strong company can decline under poor management. That's why investors should analyze CEO track records, corporate governance, and leadership decisions when evaluating a stock. How to avoid a value trap and look out for a stock you own that's becoming a value trap. You need to look beyond valuation ratios and analyze revenue growth, competitor advantages, and industry trends. Make sure to assess free cash flow. If a company isn't generating enough cash, it may struggle to sustain its operations and can cause serious problems later down the line. As we've previously mentioned, make sure to check management equality and whether executives are making smart strategic moves. It's so important for a company you're investing into to be making good decisions that benefit the company and the shareholders. This is especially important for the long-term decisions within the company, as we are long-term investors, so it's no good only looking at the next 6 to 12 months. You want to be looking at the bigger picture, zooming out, looking at their 3, 5, and 10-year plans. And finally, remember to compare against industry peers. If the whole sector is struggling, the stock may be cheap for a reason. Always do your full research on a company and make sure you don't ignore anything that seems off. Have you ever come across a stock that seemed cheap but turned out to be a trap? Let me know in the comment section down below. Or even worse so, do you think you currently have any in your portfolio right now? So, remember that if you buy into a value trap, you will be expecting a rebound, but are more than likely going to face prolonged underperformance or further declines in the stock, and your money could be working harder for you elsewhere. The key takeaways are that not all cheap stocks are bargains, some are priced low for valid reasons. You need to look beyond valuation metrics and analyze business fundamentals, industry trends, and catalysts for growth. Also, make sure you avoid companies with deteriorating earnings, weak management, or secular declines that may prevent recovery or improvement to the stock price. By conducting thorough research and considering both qualitative and quantitative factors, you can differentiate between a true value opportunity and a value trap, ultimately making more informed investment decisions. I hope you are able to take something from this video today and will be more cautious in the future when potentially buying a stock. Remember, if it seems too good to be true, then it usually is. Thanks for watching. If you're building a portfolio for passive income and financial freedom, don't forget to like, subscribe, and hit the bell notification so you never miss an update. If you've enjoyed this style of video and want other videos explaining through key investment terms, then let me know in the comment section down below. Until next time, keep compounding and stay patient in the market because your future self will thank you. But for now, this is the Geordie Pig Investor, over and out.